then I'll go back quickly, but I'll just go quickly through what I just said because it probably helps if you can hear it. Looking at the administration's economic policy, our real goal here, the real goal of the administration is rebuilding the economy. When they're looking at what's going on in the economy over the last 4 years and even longer, when you look at the very top line numbers, when you look at GDP growth, when you look at unemployment rates, and when you look at inflation, two of those three are pretty good. Unemployment is near all-time lows. We're running around 4% right now. When you're looking at GDP growth, it's not bad. It's definitely not shrinking, and it's reasonable for a mature economy. And then, at least for inflation, it's tracking back in the right direction. And in my opinion, and I think what the administration thinks, is that those are very misleading numbers, that they don't really show what the average American is feeling when they're going to the grocery store and spending what is probably more like 50 or 75% more than they were 5 years ago. Or when you're looking at housing, or when you're buying a new car, all these expenses have gone up substantially more than the current inflation rates really indicate. And their goal here is to rebuild the economy in a way that benefits a wider swath of Americans. And this is a good time for me to say, nothing I say here today is political. This is my best approximation of what is going on and what we can do to prepare for this. Because whether we like things or not, I like to use the analogy that I'm a football player. I'm a linebacker playing on the defense, and I'm looking to see where the ball is going. I'm not trying to judge whether the opposing coach has a good game plan or not. That's not where I'm at. I'm just trying to play the game as best as I can. So to that, how do they rebuild the economy? They're looking at restructuring trade. Right now, the American economy is built as an importation economy, that we run a deficit every year, trade deficit. And that means that we buy more goods from overseas than we export, whether that's goods from China, Mexico, Canada, across the board, Southeastern Asia. Across the board, we buy a whole lot of goods from overseas. And when you look at what the Trump administration is planning on doing and what they're trying to do, it really appears that they're trying to take a more isolationist approach that allows us to be more self-sufficient. And a lot of that's going to come down to restructuring trade, and tariffs are a big part of that. And then the third portion is resetting asset prices. And by asset prices, I mean home prices, and I also mean the stock market. And that's where things get a little scary, and I totally understand that. I'll talk more about it in a minute, but when you look at the stock market by almost any metric over the last 2 years, it's significantly overvalued. Whether that is the Case-Shiller Index, the CAPE Index, you can look at the Buffett rule. There's a lot of indicators out there that showing that the stock market is one, sometimes two, and I've seen one or two, there are even 3 standard deviations above its typical valuation metrics, and that's incredibly high. So to that end, I think the administration is okay with having that reset, and especially, I'll talk about this in a minute, but if the reset happens early, pragmatically, it's easier to blame that on the last administration, not what's going on now. So go ahead and jump on in and talk about deficit spending. So right now, the U.S. spends about 6% more. We're running a deficit about 6% of our GDP. That's a really big number. And when we're running a deficit, we're taking that money in by essentially taking loans in the form of U.S. Treasury bonds. The government borrows money, they issue bonds, they sell bonds. The money that comes in is used for running the government, and then they pay interest on those bonds until they mature, at which point they probably just roll them over into a new bond. And so when you're running a 6% deficit, that's when the economy is nominally strong. That really becomes a problem when the economy is not so strong. So if we do have a recession and GDP growth drops, or we actually see contraction in the economy, all of a sudden, to keep that same 6% deficit, it's actually going to be the same level of spending. That 6% deficit is going to go to a 7.5% deficit, and that's if we have a 20% drop in GDP. I know that's really big, but just know that to keep that same level of spending, it takes more. The converse side of that is ideally when this economy is strong, that's when you don't want to be running a deficit. That's the time when you want to have your spending in check because this is as much tax income as you're going to have coming in, and you want to make sure that your economy can run on that, your government can run on that. Because also, if we do have a recession and all of a sudden that deficit really kicks up, it takes away our options. A lot of the options that the Fed and that the Treasury uses to fight to keep recessions from turning into depression, if they're already running a huge deficit, it takes away some of those stimulus measures that they could have used otherwise. So Treasury Secretary Scott Bessent, super smart guy. I don't know his net worth, but I know it's huge. He was the chief investment officer for George Soros, which is an odd tie-in. But his goal is taking that 6% current deficit and pushing it closer to a 3% deficit. Looking at inflation, I'm of the camp, and if you've read my newsletter, that I think inflation is a bigger issue than the Fed seems to think at the moment. When you look at the Fed, when you look at Wall Street expectations, they seem to be pointing in the direction that interest rates are going to be cut because inflation is not as much of a concern as it was, say, a year ago. I think that kind of understates where inflation is right now. And some of that's anecdotal, but some of that's just looking at the methodology that is used by the Fed to actually track inflation, whether it's CPI, a couple of different metrics that they use, producer price index, a couple of things there. But what the Trump administration seems to be doing to fight inflation is really knocking down demand, pushing down folks' desire to buy right now by creating uncertainty. Do we have tariffs? Do we not? When I was preparing for this, I started to list out what tariffs are out there and when they're going into effect. And frankly, it's a mess because short of following True Social, it's hard to figure out where each tariff on each individual country or European Union or just general bloc, where they stand. So by creating uncertainty, that keeps people from buying because either they can say, maybe I can hold off for now. No, to be fair, it also pushes some people to buy now and go ahead and load up and to try to circumvent the tariff. But longer term, it creates uncertainty and lowers demand. And then lowering demand is, supply and demand. If your supply is staying the same or fairly close to where you started, and your demand lowers, then your prices are going to go down or they won't go up nearly as much. So at the end of the day, this is a way of really stomping out inflation. Now, it's a very blunt tool to lower inflation, but it is a tool to lower inflation. I mentioned the post-World War II trade order, just the fact that we are a net importer these days. Where that came from was post 1945, all of a sudden the United States and the USSR entered into the Cold War. And you saw that nations were realigning, and you had the NATO powers, the Western powers that went against the communist bloc in the eastern side. And one of the things that the U.S. did was they used the carrot or the stick. And the carrot was for all these countries that had trade, that had their economies just absolutely crushed during World War II, they said, we will buy all of your goods. You ship your goods to the U.S., we will have an open market, no tariffs, and we will be the importer that provides the money so that your economy can grow and prosper. And up until 1990, it absolutely made sense. When you were trying to say, for the global south, for the small countries that either weren't aligned or were considering their alignment, being able to say, yeah, we will buy your oil, we'll buy your natural gas, we will trade with you, and we'll provide safety so that you can trade with other countries free. You won't have to invest in a navy, you won't have to invest in all these different parts. We're going to take that on, And all you have to do is vote with us at the UN or support us in what we do and, act as a unified bloc. Totally made sense. But 1989, 1990, the wall came down in Berlin. You look at the fall of the USSR, yeah. I thought I used three S's for a second. And then where we're at coming into 2024, and it's a very different world today than it was 35 years ago. For all those years, it made sense that we had a 350 plus ship Navy. We had, well, really 400 plus. We had a huge Navy, so we could guarantee the safety of trade worldwide. And now we're looking at it and we're reassessing as a country. And the Trump administration in particular, they're reassessing, is that in our best interests? And their expectation seems to be no, that we need to have more exports than we do now. Right now, we are a net importer, but whether we end up being a net exporter or if we just run a lower trade deficit and import less, that's a positive for our country. And then the third item is, I mentioned, a reset of asset prices. And one of the big things there is housing affordability, because I don't know what generation everyone belongs to, but for millennials, for Gen Z, for plenty of Gen Xers, home ownership is almost out of reach. It's an incredibly hard thing to do. Between the way that home prices have gone up, even just post-COVID, and then add on to that, mortgages are now, I think the average last week was 6.9%. So tie those two things together and just numerically, rule of thumb is you shouldn't spend more than 32% of your gross income on housing. The amount of income that it takes to be able to afford even just a starter basic average home at that rule of thumb is just unobtainable for most people. So what the Trump administration is looking at doing is lowering mortgage rates. Mortgage rates are often tied off the 10 to 30-year treasuries, depending on which one you're looking at. And by lowering mortgage rates, that's going to make financing more affordable. An economic slowdown would also reduce housing demand, at least in the short term. And that reduced housing demand typically should lead to lower housing prices. Lower prices will allow more Americans to be able to buy homes, and tying back into the lower mortgage rates, hopefully it'll also allow home builders to more economically build new homes, because right now that's one of the issues is that I saw the PVA in Lexington was speaking recently, and he was talking about the number of new homes that were being built in Lexington, and the average new home build was in the mid $400,000 range. And it's hard because to be able to build that 1,500, 2,000, 2,500 square foot home, the input prices are just so high that to be able to price it even competitively, it still ends up being far out of reach for the average consumer. So the cost of inputs, and looking back at inflation, all go into that home affordability. So what has the Trump administration done? Three things that really comes down to tariffs. I'm not going to go into each individual tariff again. It's, like I said, it's too hard to track. I'm sure you all watch the news. A lot of the big places that are being tariffed: Canada, Mexico, China, potentially the EU, and some others. Spending cuts. And spending cuts and the federal employment kind of go together, because this is where DOGE comes in. That DOGE is starting, they're taking a very tech-forward, first principles approach and saying, or you could even call it zero-based budgeting, and saying, okay, starting at the beginning, who's actually necessary for the government to run? Love it or hate it, not going there, but they're slashing and burning. And again, this creates that economic uncertainty that I mentioned a minute ago that tamps down demand, which can also lower inflation. It's like I said, it's a hard way of doing it. It's not a fun way of doing it, but it can work. So is this working? So far, looking at the market, asset prices there, sort of. When you're looking at the S&P 500, it's down 9.86%, 9.87% since its all-time highs a few weeks ago. When you look at the NASDAQ, it's already down, I think, 12 to 14%. Honestly, I don't remember based on today because I haven't done the numbers today. But it's down, it's into correction territory beyond 10%. And across the board, all major indexes are down. And then looking at the debt management, I was talking about the national debt earlier. We do have one other issue there, and that's over the last 4 years, Secretary Yellen, former Treasury Secretary Janet Yellen, when she was actually financing the debt, because one of the major things that Treasury secretaries do is they actually are in charge of how do we issue debt the government can run. And when I say issue debt, does that mean do we finance it using 3-month Treasury bills? Are we looking at 1 year, 5 year, all the way out to 30-year bonds? And one of the things she did was that she really focused on the front end of the curve. So she was looking out to 1 year or so. And the problem with that is it was fine in the beginning because it provided demand in that part of the market. But all those short-term bills have to be renegotiated. They have to be rolled over essentially because we can't pay them all back, not yet, and something we should be able to do in the future. But right now, you have to, just like you're refinancing a mortgage, you have to refinance each of those. And so say you have a 1 year Treasury bond. Once that 1 year comes up and you're borrowing again, you're at the mercy of the market, depending on where market interest rates are at that point. So because we have all that debt at the front end of the curve, and it was issued in 2020, 2022, and at that point, rates were super low. Now rates are, call it 4 to 5%, depending on the maturity you're looking at. That our national debt is becoming more and more expensive, and you're going to see that more and more of our national expenditures are going towards debt because of that interest rate. That's what it all comes down to. And so when you're looking on the yield curve, one of the things you're probably going to be hearing more and more about is how do we move out the yield curve? So instead of financing a 3-month bill at 4.3%, does it make sense to go ahead and finance that debt for 5 years at 4.06%? By pushing that out, that gives us better cash flow because we're spending less money on servicing the exact same amount of debt. We're not paying that extra interest. And it also gives us time that we can get all the other stuff, the spending issues that I mentioned earlier, under control. So essentially the goal here is to push for lower long-term interest rates. When you look at what President Trump and what Secretary Bessent have said, they're really benchmarking right now off of the 10-year Treasury rate. And to put it in perspective, when President Trump entered office, the 10-year Treasury was trading at 4.75%. And today it's closer to 4.25%. So we've had a 0.5% drop in 2.5 months. And that's a huge move in the treasuries. It's not the stock market where you have 10% moves. 0.5% in a treasury, that's a big deal. One thing that you might be seeing, and it's kind of interesting because President Trump talked about this in his first term in office, but at the time, the 100-year Treasury was kind of roundly poo-pooed. Everyone just kind of laughed at it and said, oh, no, that doesn't make any sense. We're not going to do that. But essentially, he proposed that back when rates were, 0, 1, 2%, that we issue a 100-year bond. And it would probably lock in a 2 to 3% coupon rate. There are plenty of nations that would want to buy these because they're a great asset that they could use in their financial reserves. But for us, the benefit there is we're spreading that debt out at a 2 to 3% interest rate. And when you're thinking about that 2 to 3% rate, the great thing there is you have nominal rates, which are, if you see the rate, that 4.06 I mentioned earlier, you have the nominal rate, you have inflation, and then you have the real interest rate. And the real interest rate is basically what you're paying after inflation, because inflation makes your debt cheaper, essentially. So if you have a 3% long-term nominal yield and you have 2% long-term inflation, your real yield over that time that you're actually paying, the actual cost, is only going to be 1%. And that's really not bad. So I think this is something we probably will see again over the next year or two. at least brought up and discussed. I talked about the timing of all this earlier. One of the things that Scott Besson said was, right now we're still in Joe Biden's economy, but in 6 to 12 months, it's going to be Donald Trump's economy. And I think when you think about what's going on and what changes are being made, it really makes sense from a pragmatic view that it's better for the administration if a recession does begin, or a correction, or the stock market has more volatility early, while they can lay off some of the blame onto the previous administration. And so that's what we're seeing right now. I think that's one of the reasons why you're seeing such wide wholesale changes, as opposed to some of the more measured, smaller incremental changes that past administrations have made. And I talked about the President Trump's focus on the 10-year. I just want to have a quick education moment on how the bond market works, because you hear all the time that the Fed is going to raise rates or the Fed is going to cut rates. When you hear that, what the Fed actually controls is the short-term interest rate. They control the Federal Reserve rate, which is the prime rate. I'm sorry. The Federal Reserve controls the overnight rate, and it ends up being the very, very front, and it's what banks can borrow money from the Federal Reserve. Right now, it's 4.3, somewhere in that range. And from there, that does really highly affect the short-term treasuries. So if you're looking at a 3-month, 6-month, 12-month, it affects those. But as you go further out, the 2-year, the 5-year, the 10-year, what the Fed doesn't affect it nearly as much, and not in a very linear fashion. At that point, you have rates set by the bond market, and that's the bond market saying, how much do we expect in return to loan you this money, based on your risk, based on how much inflation we expect in the future, based on future economic growth. What is our expected rate of return? And so when you're looking at those, inflation expectations are huge. And so when you see that the 10 years dropped from that 4.75% to the 4.25%, it comes down to a couple of different things. I think a big part of that is inflation expectations. When you look at inflation expectations, I think that is the bond market saying we expect inflation to be less over the next 10 years. I think it's also the bond market saying that GDP growth is probably going to be a little lower over that time frame, because inflation and economic growth both play into the 10-year treasury rate. The higher GDP growth means that the bond market, and just the market in general, they can have other options, because at the end of the day, whether you're a bank, an investor, hedge fund, whoever, you have different options for where you can put your money. If you have $100, you can buy a bond and clip that coupon at very low risk and get 4%. Or if you expect that economic growth is going to be really high, and that the GDP growth is going to take off and everything's going to grow, then you can probably expect that the stock market's going to do well during that point. And so you have different alternatives. So economic growth, the higher expected economic growth, tends to lead towards higher yields as well. And then finally, creditworthiness. Just like if you're taking out a mortgage, if you are Joe Schmo with a 515 credit score, you're going to pay a lot higher rate if you can get a mortgage versus someone that has an 849 and a super high income. So the better your credit, the lower interest rate you're going to pay. So I mentioned that 0.5%, I think that comes from the inflation and the growth expectations. Now, what has happened in the stock market? I mentioned, numbers-wise where we are. And let's talk about what actually influences the stock market. And really it comes down to two different things. One part of that is the fundamentals. Fundamentals comes down to how much money are companies making. That's what drives everything else. Profitability, earnings, how fast those earnings are growing, all that stuff. But you also have the sentiment side of it. You might have heard it discussed as called the animal spirits. And this is investor psychology. This is the investor confidence in the market. And so When you're looking at the market over the last 3 weeks, fundamentally, nothing's changed. When you're looking at earnings, we're not seeing any real change in earnings from 3 weeks ago because there's no impact there yet. But what has changed is the sentiment. And the sentiment is changing because over the last year, really the last 18 to 24 months, the market's completely shrugged off any bad news. When you look, it's honestly been remarkable that the market has just continued to make all-time highs. I was actually very surprised. I thought that we would have more of a correction last year, but we didn't. The market just kept shrugging off. But now, because of all the uncertainty, that sentiment's changing. It's turning more negative. And where I think we're going to see that is we're going to see increased market volatility, because when the sentiment is negative, we're going to get back to the point where bad news is reflected negative in the market. Over the last year, we were in this place where we wanted to make sure, I say we, I mean, as the entire market, when bad news came in, say inflation went, or really if unemployment went up, that was a reason why the Fed would keep rates, or why the Fed would drop rates. And so bad news actually turned out to be good news for the market. And I think we're past that now. So right now, market sentiment is changing, and we're going to see that shift going forward. So what is a recession? Because that's what everyone's talking about. There's a technical definition. The mechanistic definition of a recession for decades has been 2 quarters of negative GDP growth. Taking it a little bit wider, now it's actually based on a number of factors, and there's not one specific mechanistic definition, but essentially it's when there's a significant decline in economic activity. And the National Bureau of Economic Research is the group who defines when a recession begins and when it ends. And typically you don't know when a recession begins until after. It's incredibly hard to be able to say, oh, today is when it began, when the recession began. Instead, it's a quarter from now, and you look at the numbers that came out and you have, trailing indicators. That's when you say, oh, okay, well, based on the GDP growth, yeah, it was about right then. So that's why it's hard to say, are we in a recession right now or are we not? There are some rules. There's the SAHM rule, which is SAHM, which is essentially looking at unemployment and a rolling 3-month unemployment number. And anytime that unemployment number jumps above 50 basis points, or 0.5% higher than that rolling average, then that correlates really highly with being in a recession. And that's a pretty current indicator. It can tell you within a couple weeks, but it's not 100%. Nothing's 100%. But at the end of the day, recession is the economy slowing down, the economy actually declining. That's all a recession is. Are we in a recession? It's really hard to tell right now. When you look at many numbers, though, I think the biggest indicator of a recession for me is consumer confidence. It's consumer spending. And because the American consumer is 70% of the US GDP. And when you look at consumer expectations, when you look at what our spending numbers are, when you look at one of the biggest things I also look at is default rates, whether that's for revolving credit like credit cards, or whether it's for mortgages, automobiles, across the board. And we're seeing that all those numbers are going up. People can't, they can't pay their bills. That's a problem. And I think that will flow through to where we see an official recession. Are we in an official recession right now? I don't know. So looking at a couple of statistics, though, because I think this is always kind of helpful. I mentioned this earlier. Folks think about 2007, 2008 as a recession, the recession. And it was the Great Recession. But it's not the average recession. We've had 31 recessions going back to right after the Civil War. Over that time, the average recession lasts 11 months. The longest was 18 months, and the shortest was 6 months. There's a lot of variation there, but big takeaway is that they're not 5 years long. We're not looking at the Great Depression that lasts from 29 to really the entry in World War II in 39 or 40. Where recessions are much shorter than that. And what does the stock market do during recessions? Frankly, it's not really correlated. This is what kind of blows me away when you actually look at the numbers. Because again, we all think about the Great Recession. There's a lot going on. We had a bubble, and the bubble burst, and that led into the Great Recession. It was the housing bubble. But when you look statistically, there's not really correlation between what the stock market's doing and GDP growth. You can see here, yes, there are a few more that are down, and there are some that are significantly down. The black is 2008, but there are also recessions in which the market goes up. On average, the market peaks about 5 months before a recession begins, and recovery, I will show you these numbers in a second. On average, the S&P 500 takes 647 days to recover to where it was pre-recession. But again, in the 31 recessions since the Civil War, 16 of those have actually had positive returns. So a recession is no guarantee that the stock market's going to go down. It's only saying that the economy is declining. So here's why you probably came today. You were looking for the 5 strategies on what you can do to actually protect yourself during a recession. And the first thing, and let me make this a little bit bigger. I apologize. I should have had that done already. But the first thing you can do now is really look at your risk tolerance and say, is my portfolio set up to match my risk tolerance? And what I mean by that is, if the market dropped 20% over the next 2 weeks, would you sell? Would you hold? Or would you want to buy more? There's no wrong answer there. But if you are inclined towards selling, then you should probably make those changes ahead of time so that you have a portfolio that you can, at the minimum, hold even through a downturn. Because as one of my mentors always like to say, you've never locked in losses until you sell. And when you look at all those recessions, those 31 recessions that I mentioned a minute ago, they all did come back to their starting point. It took several years in some cases. On average, it was a little bit less than 2 years, but they did come back. The problem would be when folks would get scared, they would sell, and then they would essentially just miss out on all that growth on the back end, and they just locked in their losses. So the good news right now is that while, yes, the market is down, the S&P is down 4.5% so far this year. The good news on that is that we're still up 8% from where we were this time last year. And so you're never going to time the market perfectly. You're never going to time the top perfectly, and you're never going to time the bottom perfectly. It's impossible, statistically impossible. But knowing that we're still up 8% over where we were a year ago, it's not a bad time to say, okay, being realistic, I'm not as aggressive as I thought that I was, because everyone thinks that they're aggressive, very strong, firm believers in their portfolios until volatility hits. And when volatility hits, that's when many folks say, I'm just not quite as aggressive as I thought I was. Now's the time to go ahead and think that through and rebalance into a portfolio that matches your risk tolerance. And one of the things you can do there to match your risk tolerance is make sure that you have the income you need. If you're retired already, I typically recommend 4 to 5 years of income set aside into bonds. I'm boring. I use treasury ladders for most folks, that no matter what happens in the market over that 5-year period, your income is protected, where it's coming from, and you don't have to sell a single share of stock unless you want to. And so by taking this time when we're still up over last year, it's a good time to top off your income buckets. Calculate at least 2 to 3 years and use this as a time to rebalance. Take some of that, fill up those buckets, take the gains, and just take some of that risk off the board. Coming into it, if you're a couple years out from retirement, I still don't think it's a bad time to make sure you have, again, 4 to 5 years of spending. It's a little harder to figure out exactly what your spending is going to be, but it is possible. You can back into that number. There are different ways to calculate it. And then finally, or not finally, but the third strategy is tax loss harvesting. You know, looking at your gains over the last few years, you probably had some pretty solid gains if you've been invested. But you can take some of those losses and you can use those losses to offset the gains and lower your overall taxes. So identify your losses. You can sell those who have lost money. And this is only going to be in a taxable account. It's not going to be in your retirement accounts, but you can use those losses to either offset capital gains that you already have in your portfolio, or you can use up to $3,000 to offset active income in a given year. And so say you had 10,000 in losses, you used 3,000 this year, you can carry forward the remaining 7,000 into the future, so you can use it for the next several years and you don't lose it. So tax loss harvesting is, it's key. Roth conversions. It's actually a really good time for Roth conversions, because if you think about it on the basis of converting pre-tax money to post-tax money, essentially you're taking money from your pre-tax pot, your traditional IRA, traditional 401k, and you're going to be paying taxes on it, and you're going to put that money into your post-tax, your Roth account, and then it's going to grow tax-free from there. So why this is a pretty good time to do this is if you're looking and you're going to convert an investment. So say you have XYZ stock that it was trading at $100 per share, and now it's trading at $80 per share. You can go from 10 shares at $100 per share, so $1,000 total, to now 10 shares at $80 per share, $800 total. You're going to be paying less taxes on that $800 than you would $1,000. You're going to be converting the exact same number of shares, and then you're going to have that rebound growth in your tax-free bucket. So there's not really a loss there. It's a great time to make those conversions. And if the market falls even further and you find at the end of the year that you converted, but the stock's down even more and it didn't work out as well as you thought, you can always actually reconvert it back, recharacterize that conversion, and you get a do-over. And then portfolio rebalancing. All of the things I've mentioned so far have kind of tied into this, but you need to start out with your base allocation. It can be 60-40, it can be 70-30. It can be based on the number of years of income that you want to keep protected, and then equity beyond that. A lot of different options. But from there, you need to either rebalance on a regular schedule. It can be quarterly, it can be semi-annually, it can even be annually, totally fine. Or based on triggers, that if a certain sleeve of that portfolio gets more than 10% out of its boundary, so say you started out at a 60-40 portfolio and stocks do great, and all of a sudden now you're at 75-25, then it's probably time to rebalance, and that's going to be a drift trigger. So where do I like to go as far as tactical places right now? Going back to, I think we're in an isolationist place with our economy. And I think that's where, talking about looking where the ball is going. Right now, I think that there are several areas, including defense specifically. I think, excuse me, when you look at defense, it comes down to a lot of things. One, despite the fact that 8% annual defense cuts have been announced, I think that's only going to be, I don't think that's going to be implemented at the level that they announced. Beyond that, it seems to be that they're going to be kind of selective about how that money comes out, and that there are going to be several places within the defense budget that actually end up really benefiting. Next up is domestic manufacturing. When you look at where does the administration really put their emphasis, it's on bringing manufacturing back to the U.S. So investing in manufacturing here is an area that I really like. Taking that a step further, what does it take to manufacture here in the U.S.? That comes from the infrastructure, the roads, the bridges, which also kind of got a bump from the CHIPS Act, all the stuff that's happened at the Inflation Reduction Act at the end of the last President Biden's term. All these go back to make me really like infrastructure. And also on infrastructure it kind of ties into infrastructure and energy independence both tie into AI. I'm not going to talk about specific companies here, but there are several AI companies that I think were significantly overpriced. I'm not going to touch on them specifically, but I think their prices were just crazy high. But when you look, there's also, you can take a picks and shovels approach to AI and say, okay, yes, you have to have chips, you have to have data, but you also have to have energy. Because when you look at the energy that it takes to run a data center, it's a huge amount. And there are so many places across the country, Northern Virginia being one of them, that they're actually constrained not by the amount of data centers they can build, but by the amount of data centers that they can actually power. So I think when you're looking across the US, power consumption is going up. And I think that's only going to go up even higher. I think we're actually underestimating the amount of power going to be used going forward. And so infrastructure and energy independence are great areas to be looking at. And just to bring it all back together, it's a great time to rebalance. It's a great time to look at the risk in your portfolio. If you're not sure what the risk in your portfolio is, that's where I can help. Happy to sit down or talk virtually, because that's what we do these days, and go through a portfolio risk analysis for you and really say, okay, this is your portfolio. These are the risks that you're taking, and help you to be able to quantify what that risk actually looks like. From there, we can develop a plan to actually mitigate that risk, or say, that's an appropriate level of risk and you're good to go. Finally, if you want help, I can help actually implement those strategies. If you want to take the portfolio risk analysis and just run with it yourself, also totally fair. If you are interested in this, just shoot me an email and we'll get it set up. But for now, are there any questions? I think everyone can actually hear me, so I'm glad, and I apologize for that earlier. But yeah, are there any questions, any thoughts, comments that anyone wants to make? Okay. Well, with that, I want to thank you all for spending your lunch with me, and hope you were able to take something away from this. Like I said, I know we're going through some scary times, so you can feel a little unnerving at times, but there are a lot of things you can do, and it's not too late to start. So check out your portfolio, make sure your risk is on point, and if you need to, go ahead and rebalance. And with that, have a great day.